$180 million. That is what a US regulator said the company at the center of this story agreed to pay, after admitting that its soaring sales were not what they seemed. A coffee chain promised a frictionless, app-first future and a store on every corner. The playbook looked familiar. Blitzscale, subsidize, capture market share, then monetize. But financial markets are not ride-sharing apps. They are policed, sometimes slowly, often imperfectly, but policed. When numbers diverge from reality, the gap shows up in cash, in controls, and eventually in court filings. This is the story of how an upstart tried to outrun gravity by manufacturing growth on paper, how gatekeepers fell behind, and how regulators on both sides of the Pacific responded. Luckin Coffee, a China-based coffee chain, presented itself as a technology platform that happened to sell espresso. Orders ran through a sleek mobile app. Coupons and buy one, get one vouchers drove foot traffic. Hundreds of minimalist stores opened in malls and office towers, optimized for pickup rather than lingering. The narrative was irresistible, a domestic challenger going head-to-head with a global incumbent and remaking consumer behavior at tech speed. The listing venue and regulatory ecosystem added credibility. As a foreign private issuer in the United States, the company filed with the Securities and Exchange Commission, traded on a major exchange, and attracted global institutions. In China, the State Administration for Market Regulation stood as the watchdog for advertising, unfair competition, and consumer claims. Layered atop this was a structural tension that every cross-border investor understands. Audit work papers housed within one jurisdiction, disclosure obligations enforced in another, and a chain of trust that can fray under pressure. The cast of characters carried clear incentives. Luckin Coffee, the issuer, sought capital and validation in U.S. markets to fund frantic unit growth. Senior executives in operations and finance were measured by aggressive store openings, rising ticket sizes, and same-store momentum. The external auditor had to opine on financial statements while navigating restricted access to underlying evidence across borders. Short sellers, some anonymous, some well-known, had monetary and reputational incentives to test the rosy narrative with on-the-ground checks. U.S. regulators focused on investor disclosure and truthful filings. The exchange policed listing standards. Chinese authorities focused on market integrity and consumer protection. And ordinary investors, large funds and individuals alike, bought into a clean growth curve backed by the aura of technology and the comfort of audited numbers. The timeline moves quickly. In 2019, reported revenue and unit growth suggested a rare consumer rocket. In January 2020, a detailed short seller dossier began circulating, citing thousands of hours of store observation, receipt sampling, and traffic analysis, to argue that reported sales were inconsistent with observed activity. In early April 2020, after the board's audit committee retained outside counsel and forensic experts, the company announced that a senior manager and others had fabricated a large portion of 2019 sales, primarily during the second through fourth quarters, and that certain expenses had also been artificially inflated. Trading was halted. By late June 2020, the exchange began delisting proceedings. The issuer withdrew its request for a hearing, and trading in the U.S. listing ceased on the exchange. In September 2020, China's market regulator issued administrative penalties against company affiliates tied to the falsification. In December 2020, the U.S. markets regulator announced a civil settlement with the issuer for accounting fraud. In February 2021, the company sought Chapter 15 recognition in a U.S. court to protect U.S. assets while a foreign restructuring advanced. In the Cayman Islands, where many China-based issuers are incorporated, a scheme of arrangement to restructure convertible notes moved through the courts during 2021. That is the arc through the end of 2021, and that is where we stop. Mechanically, how did the illusion work? Begin with incentives. The model depended on showing explosive same-store sales, soaring app engagement, and rapid unit expansion. Coupons lowered the effective price, encouraging first-time trials and pushing transactions into the app, generating a granular data exhaust that could be showcased to investors. According to the company's own internal investigation, a significant portion of reported 2019 sales did not reflect genuine consumer demand. Fabricated transactions, booked to appear as real orders, padded revenue. Certain expenses were manipulated to keep reported margins roughly aligned with the narrative. In a system that valorizes growth above all, it is deceptively easy to script top-line momentum if controls over-order origination. Reconciliation between payment receipts and recorded revenue, and third-party confirmations are weak or circumvented. When most orders run through proprietary software, the general ledger and key performance indicators can be made to reconcile internally with the push of a keyboard. That is precisely why robust assurance must triangulate back to hard evidence. Bank statements, reconciliations between payment processors and order logs, shipment validations for raw materials, and surprise inventory counts. Insight is intent on cheating target choke points least visible to an external reviewer working under tight timelines. If control owners are judged primarily on growth targets, exception reports can be rationalized away and whistleblowers ignored. Follow the money and the incentives, and the picture sharpens. In a fast-scaling chain, bonuses in careers hinge on opening units, lifting ticket sizes, and sustaining same-store momentum. Capital markets reward beat and raise quarters. Research coverage repeats management storylines. Convertible note holders and depository share investors rely on audited numbers and glossy dashboards. Subsidy-driven demand, through coupons and vouchers, can be legitimate bootstrapping, but it complicates revenue recognition and cohort analysis. When growth is the product, management faces a constant temptation. Make charts rise even when real cash does not. Suppliers and landlords do not accept adjusted KPIs. They need money in the bank. Controls failed at multiple layers. Internally, the audit committee exists to challenge management and protect the integrity of reporting. In this case, it did commission an investigation, but only after whistleblowing and external pressure had surfaced specific anomalies. Weaknesses included inadequate segregation of duties among those who could originate, record, and reconcile transactions, insufficient independent verification of large promotional campaigns, poor monitoring of related party exposure through third-party intermediaries, and inadequate data access controls that allowed the creation of fictitious orders without corresponding cash. Externally, the auditor must gather sufficient appropriate evidence. Cross-border constraints on sharing audit work papers, compressed reporting timetables amid rapid growth, and concealment by insiders made that job harder. The exchange's surveillance and the regulator's disclosure regime rely on truthful filings. When filings are false, enforcement becomes retrospective rather than preventive. Enforcement arrived in stages, each suited to its forum. In the United States, the Securities and Exchange Commission charged the issuer with defrauding investors by materially misstating revenue, expenses, and net operating loss. Without admitting or denying the findings, the company consented to a cease and desist order and agreed to a civil penalty of $180 million, with offsets to avoid double counting against certain shareholder recoveries. Separately, the exchange moved to delist after missed filings and the fraud disclosure. The issuer withdrew its hearing request, and trading on the exchange was suspended. In China, the State Administration for Market Regulation imposed administrative fines on corporate affiliates and counterparties linked to the falsified records and misleading advertising. In early 2021, a U.S. federal court recognized the foreign restructuring under Chapter 15, protecting U.S. assets while offshore proceedings advanced. In the Cayman Islands, the Grand Court considered a scheme of arrangement addressing convertible notes, whose holders were central to any recapitalization. Each action reflects a different mandate: disclosure enforcement in the United States, market integrity penalties in China, and creditor negotiations through insolvency frameworks offshore. The fallout was immediate and wide. Investors in the U.S. listing absorbed sharp losses as trading halted and delisting proceeded. Holders of convertible notes were dragged into restructuring that swapped old paper for new claims tied to a recapitalized entity. Employees faced uncertainty. While the store model did not rely heavily on franchising, the reputational shock complicated recruiting and retention. Suppliers, coffee, dairy, packaging tightened terms and demanded assurances from provisional liquidators. The brand retained consumer recognition even as investors reassessed its credibility. More broadly, the scandal fed skepticism toward high-velocity growth narratives among China-based issuers abroad, and hardened policy debates over audit inspection access, cross-border cooperation, and the due diligence burden on global investors chasing domestic consumption themes. There are clear lessons for evaluating fast-growth consumer stories. Explosive top-line growth coupled with heavy subsidies is not inherently suspicious, but it demands sharper analysis. Reconcile cohort behavior after promotions end. Real customers return without bribes. Seek independent indicators, volumes at payment processors, store-level cash reconciliation, and commodity inputs that scale plausibly with sales. Watch governance. An empowered audit committee with real independence is not optional. Track disclosure patterns. Late filings, sudden executive departures, and auditor disputes are not noise. Scrutinize related party exposure and opaque counterparties, especially where third-party partners sit between the company and end customers. Above all, follow cash conversion. If revenue claims do not produce commensurate cash, the story needs far more scrutiny. The internal takeaways are just as practical. Tie bonuses and promotions not only to growth metrics, but to the quality of earnings, cash conversion, return on invested capital, and durable cohorts once subsidies taper. Give internal audit real access and independence. And route whistleblower reports to a board committee advised by outside counsel, not to managers whose metrics may be at risk. In cross-border settings, pre-agree audit work paper access pathways or alternative procedures, so external auditors are not inspecting in the dark. Insist on reconciliations that bridge app-logged sales to processor receipts and bank statements, with variance thresholds that trigger real investigations rather than perfunctory explanations. For markets, the episode underscored the limits of glossy dashboards without robust verification. It also showed that enforcement works, but on a lag. Investors were not made whole by a 9-figure penalty. Enforcement is deterrence and signaling, not restitution. Exchanges can delist, regulators can fine, and courts can recognize restructurings. But the first and best defense remains due diligence that treats narratives as hypotheses to test, not as truths to admire. If you want one takeaway, take this. Growth is easy to script. Cash is not. When a company's pitch is, "We are a tech platform for everything," demand old-fashioned proof that money showed up where and when it should have, and that someone independent kicked the tires without fear or favor. If this kind of forensic breakdown helps you invest or simply make sense of headlines, share this episode with one person who follows consumer growth stories, and subscribe for the next investigation. It keeps this work independent and lets us focus on documents that matter instead of the hype.